Start recording now. Okay. Fantastic. Okay, welcome everybody. Gavin just phoned actually and said he'd been doing a live trading session and made 3 trades on, I think it was a Swiss franc. And he just asked me to mention that. So I have. Now, Tom, you ready?
Thank you, Peter. Thank you, Rita. Yes, Tom Williams here, speaking from Worthing, a nice little resort town on the south coast of England, not too far from the beach. Thank you all for listening, tuning in. Right. As you all know, I don't follow any sort of script at all. I just talk off the top of my head. And that's, I've always been like that. Even when I could see properly, I could never really follow these scripts and all this stuff. So bear with me if I make a few odds and ends mistakes here and there. Anyway, it's all lovely to talk to you. Now, we've got the S&P 500. This is the futures market. And this is a 30-minute chart. Now, there's no reason why I've got 30 minutes up, because you can read all these different time frames. They're all readable. Remember, when you look at the chart, you're looking at a language that's speaking to you. Something like you read Braille if you can't see very well, right? And once you learn how to read this market, we don't look at formulas, mathematical formulas, anything like that. The only mathematics we ever use is a 50% retracement, which I use, which seems to be quite useful, and of course, things like trend lines and that. But it's an art, reading these charts. But once you get the hang of it, you'll never ever return to anything else, and you'll have that skill and knowledge with you for the rest of your life. And I can guarantee you'll never ever regret it. Right, so we have a 30-minute chart up at the moment. Now we can see we've had a bit of a rally here, up move. Why did the market go up? There always has to be a reason, a cause, and if we look down here, we have a base, right? Now here we have a down bar look. What's that say? Volume, yeah. Right, so the signal appears, right? It's put the cursor over the bar, press F1, and you get this dialog box that tells us you have potential stopping volume. Now, because the professional money have to move in large amounts of contracts into the market, they have to do it as the market is falling. Remember, there are no friends in the stock market, and they're all at each other's throats, believe me. So when we've seen a down move, right, we've seen that the market becomes what I call vulnerable to opportunities. And the opportunity is that professional money will bully their way into the market and say, right, I think we can make a few bucks here or in some up move. But they can't hide their actions. Now, the market's closed, the pit's closed, so the volume is relatively, as far as we're concerned, it looks low. But in fact, the computer says it's not low. Potential stopping volume, right? Okay, now once we see that, we know it's not going to shoot straight up. You have to build what we call a cause. And the professionals see that stopping volume. It's a down bar look into fresh low ground. it's closed in the middle and the volume has increased, relatively speaking. Right, so once we know that it's going to be tested before they can move up. So it starts going sideways. We have here what looks like a weak bar, but that's all right. We get that often because we're looking for a test. Right? And there it is there, look. This is what Wyckoff called a springboard. I call it a shakeout. The computer calls it a test. But what it's doing is testing the level of supply relative to this here. Don't forget, it's before the market opens. So we're talking about volume before the market opens in America, right? But that is a springboard shakeout. They ram it down, put as many traders off as much as possible, trigger stops, right, and then reverse it quickly to lock as many of those traders in as possible. The market opens, they ram it up on that, but there is heavy supply present. We know that because although we know the volume is going to dramatically increase because the S&P pit opens, right, it's still high. We know it's high because we can not just visually see this, but we can see it's closed in the middle, look. That means that there's supply there. And we have a signal, right, which tells us that anyway. Read these dialog boxes. There's a lot of information there. Right. You can read all those. We don't have any secrets at all. What we know, we tell you if we can. Now what's interesting is these dialog boxes of signals have been there for years. So the market's not changing. It's going to keep repeating all this stuff. It's not like here today and gone tomorrow. This is how the markets work. Shakeouts, markups of the high volume, and then they test it, look. That is a test. It's a test of supply. Right? The volume is still relatively high, but it's a hell of a lot less than the previous bar. Right? And it's closed up on the top quarter, look. So you might call that a successful test. You would normally expect higher prices. Now I use the word expect deliberately because if you expect something, right, and it doesn't actually happen, then surely that's telling you something as well. Now the following bars, look, are what we call weak bars. They're up bars, yes, but they've all closed more or less in the middle, look. And the volume has dropped off. There is no demand there, look. And that's what's producing all these red arrows up here, look. Yeah, well, and this one. Supply, and there's another one. Right, so you've got 3 bars there with red arrows. And as I always say to Gavin, ignore the signals at your peril. And I think that there's far too much supply in this market. But it's gone up because of this down here. There was some buying here before the market opened. The pit opened, look. And that's definitely a springboard come shakeout. But there's too much supply present. But the market's not responding. Notice how it's arching over slightly. Well, more than slightly, look. That indicates supply, lack of demand. You can sum up these charts more or less within a few seconds. Once you get to read them properly. Now, Rita's sitting there, glued to her screen on her computer. And if you have any questions for Rita or Peter, please ask about this chart or any charts.
There's a couple of questions, not about this chart.
Okay, hang on.
Does high-speed computer trading cause confusion? Asks Bruce.
Sorry, what's that?
Does high-speed computer trading cause confusion?
Asking if he's talking about automatic trades.
Bruce, are you talking about automatic trades?
Or very quick reaction at the marketplace.
Yes, he says.
Yeah, so as you know, Tom,
Do you want to speak?
I wouldn't know the answer to this. The point being is that I'm just talking to Tom. So Tom obviously wasn't using high-speed computers trading 40 years ago. It didn't exist then, as far as we know anyway. And so I'm just explaining to Tom what it is. So I think he knows that. So that these are machines, Tom, that have been programmed to take trades automatically. So there's no, on the face of it, there's no human intervention at the moment of the trade. So I don't know how they do it, but you know, if it breaks resistance or support or something, we don't know. The trade is executed automatically, and there's been some talk of this in recent years, saying it distorts the market because it's not people doing it. And of course, I think there's been quite a volume of it going on. In your opinion, can it actually distort the market?
I would say no. Because although you've got an automatic system, so they say, it's still got human beings behind it. Come automatic or not, they're not going to go long in a weak market, for example. I think these computer traded programs are more for those traders arbitrage, where they do have some sort of mathematical program that tells them when they can buy one and sell the other. And that's what they call arbitraging. That makes sense. I've never done it myself, but I know there's lots of traders that walk around the floors of these places, stock exchanges, and that's how they make their living, arbitrage. As far as we're concerned, it's done automatically, and of course it's way out of our reach because you have to trade thousands of contracts to make that work, apparently. But don't worry about that. The truth lies in the charts. Doesn't matter what automatic trading does. Why should it make any difference? It's not going to make any difference at all to the balance of supply and demand. It's not going to make any difference to when you see professional money stepping in with 100,000 contracts or something like that. It's not going to make any difference when you see them testing. The biggest danger to a professional player is that some other professional is going to sell into his move up or buy into his move down. This is what they can't do. So, but that's why they do all this testing, and they're very careful about it. Any other questions?
Well, while we're on the ES, Wayne says 30 minutes ES, which is, yeah, big volume spike yesterday. Are we in an accumulation phase?
Well, I've just described what the chart is. It's got nothing to do with accumulation.
Yeah, there. That was yesterday.
Yesterday. I don't know if you can
Well, if there's high volume on a down bar, somebody must have been buying. And that's why it went up, look. If it's high volume in these down bars, this is why it went up. But there's a lot of supply in this market. That's why it's not making any progress. Believe me, if there was no supply there, that would be up. Wouldn't be doing all this. But you've got to be very careful. There's a lot of skullduggery goes on in the markets. And the more you realize that, the better informed you will be. I mean, we were looking at the Japanese yen, I think only yesterday or the day before. And it looked like a hell of an upthrust. But it wasn't an upthrust. It's too good to be true. You can't put that yen up, can you, Peter?
Yeah.
We'll just have I'll just show you this. See, an upthrust has got our rules to it. Daily chart?
I thought it was on the short time frame.
No.
It's J.
That's the yen, yeah.
Japanese yen.
Daily.
Yes. Now there's a hell of an upthrust. There it is. No, is it? There it is.
Oh, yeah.
Now, when you look at that, that's it. That's it. Now look at that. Now, technically, even the computer probably thinks that's an upthrust, but it's not an upthrust. What that is what I call corrupt data. Some rogue trader has pressed the button deliberately, shot it up like that. It's probably on up there a second or two.
Was it less than a minute?
Peter says less than a minute. He's probably watching it. Right. What it does, triggers a load of stops, misleads a load of people, and it reverses quickly. Now that's not a true upthrust. The rule, for as far as we're concerned, is a true upthrust appears after you've seen a sign of weakness in the background. In other words, if we had some sort of weakness here in this area, in other words, an up bar, narrow spread, very high volume perhaps, then it went sideways. But even then, don't forget, when they move a market like this, it costs them money. There are no friends in the stock market. And other professionals will jump on that, right? And whoever marked that will cost them money. That is corrupt data. So you've got to be careful of that. Because they're not, believe me, they're not frightened of doing that. We've seen that at times. We saw, I believe, on the Dow a year or so ago, where somebody's rogue trader marked it down. They say, oh, it was an accident, but it's not. It's done deliberately. And you've got to watch that. The old saying, if it looks too good to be true, it probably is true. Not true. Right?
Someone in the room, who was it, Rita?
Martin.
Martin was saying that it didn't happen on the spot Forex, it just happened on this future. So if you like to call it reality, in reality it didn't happen.
So you have to be very, very careful. But that's obviously, to me, when you look at that, that's corrupt data. That's a rogue trader pressing a button deliberately for a second or two. I wasn't actually watching it. The reason I know about it was that somebody rang up and said, oh, I'm going to go short that. So I had a look at it and then I gave them my opinion. So be careful. Any other questions?
Apple next for TP.
Right, somebody wants, who wants Apple?
TP.
TP. That's end of day up to yesterday. Now, right, so what we got? Well, we got weakness at the top here, look. This looks like a top reversal. No demand. Here's what Gavin calls a gotcha bar. He invented that word, and it's very good, actually. The idea is, behind that, is the professional money. They know how what I call the herd behave on these moves. Now, there'd be a lot of traders that own Apple, right? But obviously, if they knew this fall was going to happen, they'd be out, right? So what they do, they ram it down as fast as they can here, close near as low as possible, right? And that's what we call a gotcha bar. In other words, if you were long up here or locked in, you are now locked in. A lot of traders have been locked in here because the normal reaction for a human being, part of the herd, they think, oh, I should have sold, but I better not sell now because that thing may go up. It's gone down too far. And that's how the herd, they get locked in. Okay, so we get a little bit of a rally here, but classic in a weak market, look, no demand. Right. Now there is a green arrow here, right, and that's why it hesitated for a few bars, but no response at all to these apparent signs of some strength entering the market. That's what we call a weak bar. When you see a widespread down like that, especially on that heavy volume, look, and you've got what we call a top tail. In other words, a high is higher than the bar previously, and it rammed it down. That is a sign of weakness. But we know there's nothing fundamentally wrong with Apple. These are traders. The directors of these companies got no idea why these stocks move up and down. If you ask a director of Apple, well, why has your stock fallen? They shrug their shoulders and say, well, I don't know. We were just the same as we were last week or the week before. That's traders trading it. That's what causes that. So I'd say Apple, there's not a lot of supply here. There's not a lot of demand either, look. This isn't going to shoot up at the moment. This is probably going to, at the best, move sideways. It's going along here and could easily fall lower. There's nothing wrong with the company. It's just professional money trading it.
And we've got a request for C. I'm assuming C is equal to corn. A continuous contract for corn, Tom. Your views on that?
Right, corn. Well, first of all, we can see that we've had a considerable down move, look. So that's what the market needs. A down move to become what I call vulnerable. That is, a point will be reached. Same as any other commodity, any your house or anything, where if the price gets low enough, people would become interested in buying it. And we see here, we have stopping volume, look. Okay. Now, it hasn't produced a signal on this, but we can see the very high volume. We can see it's a red down bar, and we can see the low is in what I call fresh low ground. Right? So then it goes up. We're expecting a test. Don't forget, stopping volume has to be tested. It's not going to shoot up from that. It needs to be tested. In other words, you need an area of further accumulation. There's the test. Don't forget these tests come in all different shapes and sizes. The main thing is it's gone down into fresh low ground. Note the spread is narrow. Note it's closed in the middle. And note the volume is low. All the supply has disappeared. And that's why it's going up, look. Hey. I've got one. Sorry, it was Rita. Now, this looks as if it's accumulating the base to hopefully, well, not hopefully, but to become bullish. You never hope in the stock market or the markets. You have to read supply and demand. It peaked out there because of lack of demand. What's up?
Sorry, carry on, Tom. You finished that one? Yeah. So you just looked at corn there, but
That looks strong.
Tom's saying that one looks strong for all you corn followers. Now, who was it asked for C? YF asked for C, and I immediately jumped to a conclusion, which you should never do when you're trading without checking. Citigroup. Another chart, Tom.
Was there a question about this? Right. Well, we got some weakness up top here, look. No demand. Top reversal by the look of it. Falling. Now, we do have a down bar, and we do have what looks like stopping volume.
It's called a potential climactic action.
Right, it's the same thing. Don't forget, the terminology, maybe word is slightly different, but it means the same thing. It means that professional money must have stepped into the market to cause that amount of volume and to close more or less way up, look, almost in the middle. But has the market moved down far enough? Don't forget, professional miners sometimes get it wrong. They've tested it there, look. That's a test. Right, computer agrees. The volume is definitely lower, look. Now, the only thing is, now what we're looking for is a test at that level where supply is definitely dried up completely. So we don't worry about weak signals like that because we've got this stopping volume in the background here, and there's a test there. What we want is when you draw a line across here, that area, look, we want to see the market come back down to that level and the volume obviously low. If that happens, then that market's going to go up because it shows you that where there was supply here, supply has now disappeared. And that, you'll see, will force the market up because that's how the markets work. They work on supply and demand. They don't work on news or anything like that. They work on supply and demand. Professional money will obviously use news as much as they can, But that's what we're looking for. Now, what's the volume like there, Peter?
Well, it's above average. It's say it's less than the previous high volume.
Oh yes, yeah. Okay. I'd like to see that volume a lot lower than that.
And also, although you said ignore that weak bar,
Yeah. Well, that's
some impact slightly, purely.
well, yes. They want to test the market. This is what they're testing. This, so they can't test that if it keeps drifting up. I'd like to see a down bar now on very obviously low volume. That's if it's going to be bullish. If it stays high,
That's yesterday's bar, so we don't know what happened today, or do we?
there's a daily chart. All these charts are work on supply and demand, so whether it's 5 minutes or daily doesn't make really much difference. The supply and demand is built into the bars. But that's how I read that. I'd like to see that volume lower, if possible. That's if you want it to go up. If it stays high on these tests, you may get another little rally here on no demand, showing it's not ready to go up. The reason I say that is that sufficient to drop from there to there to attract professional money into that stock. Normally, you like to see at least 2 or even 3 legs down. And then they definitely become interested. Any other questions?
Yes. Pete would like BSX. BSX.
Just look at it, right?
Scientific.
Pardon?
Boston Scientific.
Right, can you put Esparza? Well, can you see we've got an up thrust here. See, that's an up thrust. It looks more like it, look. And we don't really have any stopping volume, do we? That volume's on up bar. Here, we're moving along now. Now we do have some stopping volume here. It plunged down, look, closed in the middle, and you've got very high volume, and that's why it's gone sideways. That's why it has not carried on falling. Right? But you would expect a test before that became bullish of that supply there. So you would expect, if that was bullish, for this to fall down somewhere along here, and you see very low volume, hopefully narrow spreads, then it's going to go up. But there's a lot of negativity here because you've got this up thrust here, which is definitely a serious sign of weakness. And don't forget, you need to trade in harmony with the index. It's no good going long on a stock when the index is weak and saying, oh, this is going to go up, because most stocks will move up and down with the parent index. It's quite reasonable to assume.
Alan would like us to look at SWIR.
SWIR. Right. No, that doesn't look right. That looks like the yen. Oh, that's better. Right, can we have less bars? Sorry folks, I can't see it. My eyesight's so bad that, well, okay, we've had a bit of an up move here from the base here. No supply. Now, if there's no supply, then you would expect higher prices because that's how the market works. It works on supply and demand. If there's no supply, that is selling, right, then demand must be greater than supply, and that's why it goes up like this. Now what's interesting is every time you get a red arrow, this is probably on no demand, look.
Selling pressure.
Yeah, but it says selling pressure. Okay. If you see a test after a red arrow, then you've got to assume that that market's trying to go up. Right. Now it comes in, these tests come in all shapes and sizes. Don't forget, a proper test is a red down bar, the spread is narrow, closing in the middle, and the volume is low. Now, you can always look on the bottom here. It'll tell you bar is down, volume's average, spread narrow is what we want, close in the middle what we want. Now the only negative thing is the volume's average. It'd be nice to see low volume, but even so it's still enough to let that market go up, look. However, it's running out of the volume is not bullish enough to drive that up. The red bars kick in, the red trending system down, 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 down. It's basically looks weak to me. Not weak enough to say, right, I'm going to short that straight away. But I certainly wouldn't be interested in going long at the moment. Remember, you trade these stocks in harmony with the parent index. You've got to get the parent index right first. Then you pick your stocks.
Okay. Okay. So Alan says, what would you look for to say it's going up?
What I'd like to see, if I wanted to see that going up, would be some form of stopping volume, or the other side of the coin, complete lack of supply. In other words, a red down bar, narrow spread. This is what I would like to see, what we've got here. Look. Now, things don't... Is it on there? Now, we looked at that. No supply, look. And you could do a 50% retracement on this, Peter, could you? The low and the high. This is the only formula that we generally recommend. Now why they work, I'm not quite sure. Something to do with nature, they say. Right, so it has reached a 50% retracement. But that's what I'd be looking for. A red down bar, narrow spread, no supply. But you must trade in harmony with the index. You won't entertain going long on this unless the index was going up. What's the parent index? The NASDAQ. Right, and I believe from my memory NASDAQ was churning sideways and not looking all that strong recently. Does that make sense?
Jerry is asking, why is the down bar on 10.6 not considered a reversal bar? So this bar here, why is that not considered a reversal bar?
Well, I mean, it's highly unlikely to be a top reversal because, as I say, from this fairly positive signal at the bottom here, no supply, you need to see an up move to make the market vulnerable to professional money saying, right, I'm going to unload some of my holdings. So that's not a top reversal. First of all, the volume's fallen off on this bar, and that next bar's up. So you know it's definitely not a top reversal. But it doesn't look, the market has to go up to have a top reversal. Here it's only gone up a few steps, look. And then that's why they're testing it. I mean, imagine you're a professional trader and you're in there with 100,000 contracts. Right. Now you're not going to sell when you've just made a few bars, look. It's gone up, what's it gone up? 1, 2, 3 bars. And that up there, that sign of weakness, admittedly there's some selling pressure there, seen by the high volume. But next bar, that's got to be a test, especially when that next bar's up, look. And there's your test there, look. But the market is weakish.
Okay, a couple of people are asking to look at crude oil. We've got a trend channel there.
Crude oil. Well, it's certainly, for start with, overbought, isn't it? It's above that trend line. So it makes you, tend to make you vulnerable. And then you see some high volume here. Well, where's that? That's an up bar, look. Markets don't like that ultra high volume on these up bars because that means there's supply in there. Professional money would see that immediately. Although the market continued up, look at the volume falling off. That's no demand. And then we have up thrusts here. This looks a weak bar. To me, that looks if oil's having trouble making any headway at the moment. And don't forget, we are overbought. Making trouble, making headway. And the reason is this is the main reason here. Markets don't like this ultra high volume and these up bars because that's supply present. And that's reflected in the following bars, look. You even get these down bars, look. Although the volume has dropped off, these bars that got these what are called top tails are almost built-in weakness there, look. A top tail is where the high is higher than the high of the previous bar. That means they must have done some testing sometime in the intraday charts. and that would be supply again. Look, there's an increase in volume. On that increase in volume, it's closed the middle. That's making trouble, making headway. That could easily fall off.
USO is our next request. That's the oil ETF.
USO.
Yeah, I think you have to go over to the other. Yeah, look.
Are they?
Yes, that's the oil ETF.
What the hell's that? Somebody been murdered. Right, okay. Now, you look at that immediately, you can see his weakness there, look. Why? Because look at this. How's that for weakness? Massive high volume. It's gapped up. Right.
Supply coming in.
Supply. Right. Then goes up. Look, it's got to be no demand. Is that no demand?
Supply coming in.
Supply, look.
It's quite a narrow bar.
Narrow spread. Look,
The next one looks like no demand. There was no signal on it.
well, yeah, some.
Very low volume, no signal.
Yeah, well, you know, this. Don't forget the signals are very sensitive, and that's why, if you're a programmer, you have to instruct them how. You've probably got about 5 or 6 various no demands. Basically, it's an up bar and the volume is low, especially if it's a narrow spread like that, and especially after you've got weakness. That's serious weakness there. It comes down, have a little test, up it goes, narrow spread, no demand. That looks weak. Certainly wouldn't be interested in being long on that.
Okay, so got someone here requesting silver. What is happening with silver as it may reflect on the direction of gold? And we've also got a request to look at gold as well. So silver.
Yes, well, yes, you've got to be careful here because this looks bullish. Although the reason why it looks bullish to me is you've got this gapped up huge wide spread, which we saw coincided with the top of the S&P 500. And this gold and silver tend to go in the opposite direction. All the intricacies I can't explain to you because I've been out of the market so long. But that's what appears to be going on. That's not absorption, that's not supply. Well, of course a computer thinks it's supply naturally. This is a top trend line, so we are severely overbought. But the following bars are important to us, and it looks like constant testing here. That, to me, looks bullish. Yes, so you've got to be careful there. And don't forget, if it does happen to do the opposite thing to the S&P, check the S&P. If the S&P suddenly become obviously strong, they expect gold and silver to hesitate, at least, at the best, hesitate in its upward progress.
While we're talking, Wayne's saying big drop in the ES. Yeah, Peter's watching it on his screen. Do you want to put that up on Tom's? See what? You see that, Tom? What's happened?
What did we say previously about it?
Supply and rounding over.
Yeah.
Oh,
Oh, sure, I mean,
well, we looked at this, didn't we, when you first arrived? 5:30. It's now, well, less than an hour ago, look. And it's no surprise, that isn't, because you've got supply up here. Markets don't like high volume lap bars, especially when it's suddenly followed by no demand, look. Right? That looks like a weak bar. This would be on no demand. No signal on that, but you know, the computer's not that clever. You are far cleverer than the computer, remember that. You may not be able to calculate as fast, but you've got far more logic. And that's why it's come off like this, look. But we know the overall market's weak in the S&P and the Dow.
Well, we said that we'd look at gold, didn't we, when we were looking at silver?
Yeah, that should be going up.
GC. Oh, similar story.
We've got 20 bars up, what?
yeah.
So this looks like a test, doesn't it? Now that's interesting, look. This is the daily chart of gold for yesterday. Now that, in anybody's language, is a test, look. Tests appear on a red bar, means it's down, it means it's a narrow spread, means it's close in the middle, and it means the volume's low. That is a test. Now the computer should tell us something similar. Bar is down, volume average, spread average, close in the middle. Not quite the perfect test, but it is definitely a test, look. You can see that's a test. It's down, as far as we're concerned, it's a down bar, narrow spread, closed near the high, and the volume is, that's the reason, look. It's not quite as low as we'd like it to be. There is just, but it's still a test, and you would expect higher prices. And that's probably the reason why that's going up. And we said silver and gold look bullish. It's the first time I've seen that today. And why the S&P's fallen. So the S&P's falling because gold wants to go up, look. And that's the reason it's going up. It's because you got a test there yesterday. The daily charts are very, very important. It gives you a far clearer indication of the likely direction of these instruments.
Got a question from Steve here. Says, would volume be needed or even useful on a 1 minute future trading?
1 minute.
Yeah.
Well, you know, you can read these. Some people trade on these 1 minute. It's a bit hairy because it's such a short time frame. But once you learn to read these charts, you can see for yourself whether trading in 1 minute is going to be profitable to you or for you. But it all works. But don't forget that with a 1 minute, there's not a lot happening. Or not a lot has happened. Remember, you have to have a cause, a reason for a move up or a move down. And of course, the cause is a movement of professional money entering or leaving the market. And that's what we look for. But that's interesting, that. There's definitely a test on there.
We've got a request for JPM, JP Morgan. JP Morgan.
What's it, daily? What's it? Daily. JP Morgan daily chart. Now, that's a test look. That is a test look. It's a red down bar. Test. Computer agrees with us. Right, fair enough. You would expect on a test have higher prices, although you've got a bit of weakness here. Now this looks more like a bit of a top reversal here.
Yeah, reversal after effort to rise.
Yeah, so you've got to keep all this in mind.
It's had a move up slightly.
Yeah, there is a test of some sort here, look. And there's obviously weakness over to the left here. Tested it, up it goes. But that's weakness, so you have to be careful here. But that you would expect with a test for that to go up today.
Except the S&P is not very happy.
The S&P, as Peter says, not very happy, which it isn't. You need to really trade, well, you not really, you have to trade for best results in harmony with the parent index. But they're testing there, look. But you do have this in the background, which is negative. So even if it doesn't shoot up at the moment, it's a potential good buy when the S&P 500 is ready to move up, when the cash market is ready.
Okay, it's perfect timing because we have one more question from Paul. Can you look at ROST from a start? And my question is, there seems to be accumulation. Whenever it starts to move up and there are green diamonds forming and a no supply signal appears, how does one know to buy a 1 month or 2 or 3 month options? Shall I read that again, Tom? Here you are then. You need that.
Well, if you're an option trader, you obviously buy the option. I can't see that, too many bars. Here, if you were doing options, you would trade, you would buy a put, wouldn't you? Or sell a put. Why? Because that's an obvious sign of weakness, look. It's an up bar, narrow spread, massive volume, that's falling. And those, we've got quite a few guys and ladies trade options. And the ones that seem to make the most money are the ones in only for a few days. Do not get trapped into saying, ooh, I've made a few $100 now. Means I've got another 9 months or so to run. How much more am I going to make? As soon as you think that way, you're going to lose. Because these options are cleverly worked out that they're going to lose money given enough time. But you trade that immediately, you buy a put on that, look. That is definitely a sign of weakness. Up thrust. Now that is an up thrust. I mean, it looks like an up thrust. It's not like that yen we saw, which was obviously a rogue trader press the button deliberately to mislead people. I mean, it's an up bar look, narrow spread, close on the low, volume is massive. That can only mean supply. And we've had, looks almost like a 50% retracement from the side of weakness here to the low. That's when you trade options. Okay? Wait for the signal. Wait for not a signal, but the sign of strength or weakness.
Alan's asking, why not sell the put and just collect the premium?
I mean, quite honest, I haven't traded options for some time because of my eyesight's so bad I can't really do it. So I can't see the screens sufficiently well now. That's the sort of question. Peter, do you know that one?
Not really, but it just occurs to me, if you sell a put, that means you own the underlying stock, I think. I mean, there'll be plenty of people in the room who know more than I do. But if you own the stock, of course, it might not be a good idea to own that stock at the moment, despite getting a premium, because your stock is actually falling. A lot of people, though, do actually buy stocks, hoping they'll go up, if you like, and selling the calls, doing what they call covered calls, and that is a good strategy many people apparently use. So your stock is a bullish stock, you own it. If someone wants to buy it off you at a higher price, good, you've made a profit and you've got the premium. So that's what some people do. But I mean, there's all variations and all options, loads of things, but I'm not an expert by any stretch.
Well, there's lots of comments from people here, so I'll read them out. Alan is saying, Alan first said, why not sell the put and just collect the premium? Then he says, shouldn't it waste away and the buyer will lose? Julius says, if you believe it's weak, you should sell the call, not the put. Peter says, risk unlimited, profit is only the premium for put. Park says, if you sell a put, you are betting that the stock is going up. Pete says, if you sell a put, do it at the end of a downtrend with strength coming in, not at the start of weakness. And Alan says, thanks, Peter. Tom?
Yeah, well, I may have misworded that. Didn't I?
Okay, so great. That's it, folks, for this week. And I've no idea if Gavin's on. Tom, is Gavin on later, or is he doing the Monday thing?
I'm not sure.
I know he's been on earlier, so he may. But if you go onto the VSA Club website, you'll see we're doing a newsletter on Sunday, which we'll post up. This video recording we've just about to complete with this session we put up in the next 10 minutes, I hope. And with that, we'll thank you all for coming along. I hope you enjoyed it, and we'll see you all next week. Have a good weekend and a good week.